Okay, so good morning. Again, this is Francis Kaliwan and welcome to another video on lessons in financial accounting and reporting. Our topic for today is accounting for bonds with equity characteristics, or what we call compound financial instruments. Our discussions, by the way, will be guided by the provisions of IAS 32 Financial Instruments Presentation. By way of short introduction, corporations sometimes issue bonds that allow the bondholders or the creditors to become shareholders of the corporation. They do that by either attaching share warrants to the bonds or including a conversion privilege to the bond indenture. Um, in either case, the bondholder has acquired two financial instruments. Number one is the financial liability or the bonds payable itself, and the other one is the equity component, which is either the warrants attached to the bonds or the conversion feature of the bonds payable. Before we proceed, let us have these learning outcomes first. Number one, describe the nature of compound financial instruments. Number two, explain the process of bifurcation of the issue price of a compound financial instruments. Number three, formulate journal entries relating to the issuance of bonds with share warrants and exercise of share warrants. Number four, formulate journal entries relating to the issuance and conversion of convertible bonds payable. And finally, number five, present compound financial instruments in the statement of financial position. Okay, so what is now a compound financial instrument? A compound financial instrument is a financial instrument that has the characteristics of both liability and equity. So, from the perspective of the issuing corporation or the issuer, such an instrument comprises two components. Number one is the financial liability component, which is the contractual arrangement to deliver cash or another financial asset, and the equity component, which is either a warrant to acquire a fixed number of entities' own shares for a fixed amount, or what we call share warrants, and the call option granting the holder of the instruments the right for a specified period of time to convert the instrument into fixed number of ordinary shares of the entity, or the conversion feature of the bonds payable. So what is now the requirement of IAS 32 for compound financial instruments? An entity recognizes separately the components of the financial instrument that creates a financial liability of the entity and grants an option to the holder of the bonds payable, the instrument, to acquire a fixed number of entities' share or convert it into an equity instrument of the entity. So IAS 32 requires the issuer of the bonds or the issuer of compound financial instrument to present the liability component and the equity component separately in the statement of financial position as follows. First, the issuer obligation to make scheduled payments of the interest and principal is a financial liability that exists as long as the instrument is not converted or the warrants are not exercised. Number two, the equity instrument is an embedded warrant to acquire a fixed number of entity share or option to convert the liability into equity of the issuer. Now, what is the process of allocating the issue price of the compound financial instruments between the liability component and the equity component? By the way, that process is what we call bifurcation. So let us apply bifurcation first to the bonds with share warrants. According to IAS 32, when the initial carrying amount of a compound financial instrument is allocated to its liability and equity components, the equity component is assigned the residual amount after deducting from the fair value of the instrument as a whole the amount separately determined for the liability component. So as you can notice with our formula, priority is given to the liability. Any residual amount is the value assigned to the equity component. Now, what if the market value of the bonds without the warrants is not determinable? We will use the present value of the future cash flows, or the present value of the principal and the present value of the periodic interest payments using the market rate of interest for similar bonds without the warrant. Okay, so again, in determining the value assigned to share warrant, we deduct the market value of the liability component, which is the bonds without the warrants, from the issue price of the compound financial instrument, or the issue price of the bonds with share warrants. Actually, if you can notice, that formula is in accordance with our accounting equation, which is asset is equal to liabilities plus equity. But if we are to compute the formula for equity, equity is equal to asset less liability. So again, priority is given to liability. Now, what if the market value of the bonds X warrants is not given, but what is given is the market value of the share warrant? Question: can we use the market value of the share warrant to determine the market value of the bonds X warrants? So meaning the issue price of the bonds with share warrants is given, and the market value of the share warrant is also given. What is not given is the market value of bonds without the warrants. So can we use the market value of the share warrant? No. Because um, again, talking about the formula or the accounting equation, is the formula liability is equal to asset less equity correct? Actually, mathematically, that is correct. But in substance, the formula is wrong. Because in the formula liability is equal to asset less equity, you can notice that priority is given to equity. And it is not the case in accounting. Remember that the equity participants are the ultimate bearer of risks and reward. So dapat sila yung dulo, sila yung huli, sila yung residual. So if the market value of share warrant is given, do not use that. Disregard the market value of share warrant. Determine the market value of the bonds or the fair value of the bonds by discounting the principal and the periodic interest payment. Okay, so let us apply the concepts that we've discussed in bonds with warrants to this illustration. On July 1, 2020, the company issued 5 million of its 10% 7-year bonds with detachable warrants at 108. That is our issue price. Each 1,000 bond, so meaning we will have 5,000 bonds, di ba? Kasi 5 million divided by 1,000, so we'll have 5,000 bonds. Each 1,000 bond carried a detachable warrant for the purchase of 2 shares of Cashio's 100 par value ordinary share for 140 per share. So again, 5,000 bonds times 2 shares. So we can purchase 10,000 shares at how much? At 140 per share. That is our exercise price. On that date, the market value of the bonds X warrants is 102. So that is our market value of the liability component. On December 31, 2020, a total of 3,000 warrants were exercised. So 3,000 of 5,000, only 60% were exercised, and the remaining warrants were exercised on October 31, 2021. Okay, class, before we proceed, just remember that the accounting for the share warrants is independent from the accounting for bonds payable. Diba? Alam naman natin yung accounting for bonds payable. We determine whether the bonds payable were issued at a discount or premium, and then we amortize the discount or premium through our amortization table. So ganun pa din. Whereas In accounting for share warrants, we use the share warrants outstanding account, which is an equity account, part of additional paid-in capital yan in the equity section of the statement of financial position. So it is credited when the bonds with warrants are issued, and when the warrants are exercised, the account share warrants outstanding is debited. So dito, since 60% muna, so 60% lang of the share warrants outstanding will be debited on December 31, 2020. And then the balance will be debited on October 31, 2021. Okay? So the requirements are prepare the entries to record the issuance of bonds with warrants and exercise of the warrants. Okay, so the first thing that we will do here is bifurcate. So we will allocate the issue price over the liability component and equity component. So again, our issue price is 108. So 5 million times 108 is 5.4 million, less the market value of the bonds without the warrants. That's 5 million times 102, or 5,100,000. So here we can say that the bonds were issued at a premium. The face value is only 5 million, but the market value of the bonds without the warrants is computed at 5.1. So we will have a 100,000 premium. And then the value assigned to share warrants is 300,000. So what is our entry? Debit cash for the issue price, which is 5,400,000. Credit bonds payable of 5 million. Credit premium on bonds payable of 100,000, and the share warrants outstanding of 300,000. By the way, mayroon tayong shortcut dyan ha. The share warrants outstanding of 300,000 will be used to purchase how many shares again? 10,000 shares. So in effect, each share is assigned a 3 pesos or 30 pesos, 300,000 divided by 10,000, 30 pesos share warrants outstanding. Okay, so remember that amount ha. Each share that will be purchased is assigned 30 pesos share warrants outstanding. So after the entry to record the issuance of the bonds payable with share warrants, let us now have the entry to record the exercise of the warrants. So on December 31, a total of 3,000 warrants were exercised, and that is equivalent to 6,000 shares. So our entry will be debit to cash for 840,000. How do we determine that amount? That's 6,000 times exercise price of 140. Yan, 840,000. Then debit to share warrants outstanding. Our share warrants outstanding account is decreased if the warrants were exercised. So 300,000 times how many percent were exercised? Only 60%. 3,000 of 5,000. So 300,000 times 60% is 180,000. Next, credit to ordinary share capital. So that is 6,000 times par value of 100. That's 600,000, and the balance is credited to share premium account, which is 420,000. So our total consideration of cash 840 and share warrants outstanding of 180 less the par value of the share, which is only 600,000, we will have 420,000 share premium. Actually, we will have a shortcut for that amount. We will just compare the total consideration and the par value. So our exercise price of 140 each share plus the value assigned to each share, which is 30 pesos, our total consideration is 170 per share. Next, the par value is 100,000, so our share premium per share is 70 times how many shares were issued? 70 times 6,420. Okay, so that's the shortcut for determining the share premium issuance. Next, our entry to record the exercise of the warrants on October 31, 2021 for the 4,000 warrants or 2,000 warrants or 4,000 shares. So debit cash 560, so that is 4,000 times 140. Next, the balance of the share warrants outstanding, which is 120. Diba, na-debit na natin yung 180 kanina on December 31, and then credit to ordinary share capital of 400,000, and the balance is share premium 280. Again, paano natin dinidetermine yan si 280? That's 70 times 4,000 shares. That's 280,000. Okay, so that is our first illustration for the share warrants outstanding, or the bonds with share warrants. So first that we will do here is the determination of the present value of the bonds payable without the warrant. So first, we determine the present value of the principal. That is 5 million times the present value factor. Our present value factor is based on the prevailing market rate, which is 12%. So 12%, 5 years is 0.5674. So 5 million times 0.5674 is 2,837,000. Add the present value of interest, which is at 11% per year. So 5 million times 0.11 is 550,000 per year to be paid equally. So 550,000 every year for the next 5 years. So what's the present value of ordinary annuity? 3.6048 times 550,000, that is 1,982,640. So the total present value of the bonds payable is 4,819,640, which is lower than our face value of 5 million. Therefore, we can conclude already that the bonds were issued at a discount. By how much? So 5 million times 4,819,640, a discount of 180,360. Okay, after we determine the present value of the bonds without the warrants, let us now bifurcate the issue price. So our issue price is 109. So 5 million times 109 is 5,450,000. Next, we deduct the present value of the bonds ex warrants, which is 4,819,640. So the value assigned to the share warrants is 630,360. So let's prepare the entries. So the first entry will be our entry on December 31 for the issuance. Debit cash of 5,450,000. That is our issue price. And debit our discount of 180,360,000. Again, that is the difference between the face value and the present value of the bonds without the warrants. And then credit to bonds payable of face value 5 million, and the balance of issue price, which is 630,360, is credited to the share warrants outstanding account. Next, the warrants were exercised on March 31, 2021. So all the warrants were exercised. So our entry is debit to cash for 6,250,000. Paano yan? So that is 5 million divided by 1,000. We have 5,000 warrants. And then each bond was, we have 5,000 bond. Each bond was issued with 50 detachable share warrants. So times 50, 250,000 shares. Diba? at 25 per share. So 250,000 shares times 25, that's 6,250,000. And then debit tayo ng share warrants outstanding total kasi all were exercised naman, so 630,360. And then credit to ordinary share capital, so again 250,000 shares times par of 5. So that is 1,250,000, and credit to the share premium of the balance amount, which is 5,630,360. Apply nga natin yung ating shortcut para dyan. So how much is our exercise price? It's 25 pesos per share. How about the value of share warrants outstanding per share? So that's 630,360 divided by 250,000 shares. So we have a 2.52144 value of share warrants outstanding per share plus our exercise price of 25 minus our par value of 5. So our share premium per share is 22.52144 multiplied by the number of shares issued, that's 250,000. Our share premium is 5,630,360. Okay? Okay, next is our discussion for the convertible bonds. So again, these are the bonds which are issued with the option to convert the bonds payable to the shares of the issuing company. So similar with bonds with share warrants, so we determine first the issue price of the compound financial instruments, which is our convertible bonds, and then we deduct the market value of the bonds without the conversion feature, our liability component, and the residual amount is the value assigned to the conversion feature. If the market value of the bonds without the conversion feature is not readily determinable, similar with bonds with share warrants, we will use the present value of the principal and periodic interest payment, or the present value of the future cash flows, using the market rate of interest for similar bonds without the conversion feature. Okay, so next is conversion of convertible bonds at maturity. So when we say maturity, the balance of either discount or premium have been fully amortized. Okay, so on conversion of a convertible instrument at maturity, the entity recognizes the liability component and recognizes it as equity. So meaning the bonds payable account is cancelled, debited, and then our credit will be equity. So credit tayo ng ordinary share capital and share premium account. And how about the balance of the share premium conversion feature account, the value assigned to the equity? It is also debited. The original equity component remains as equity, although it may be transferred from one line item within equity to another. So yun nga binanggit ko, equity account pa din naman yung conversion feature. And then there is no gain or loss on conversion at maturity. Now, how about conversion of convertible bonds before maturity? On conversion of a convertible instrument before maturity, the entity recognizes the liability component including the unamortized premium or discount. Kasi nga before maturity, so ibig sabihin, the discount or premium were not yet fully amortized and recognizes it as equity. When conversion takes place between interest payment dates, and any accrued interest should be paid in cash. Kasi nga, before maturity, so there might be some accrued interest. So they must be paid in cash. And then the original equity component remains as equity, although it may be transferred from one line item within equity to another, and there is no gain or loss on conversion at or before maturity. So now let us discuss retirement of convertible bonds. So when convertible bonds are retired before maturity, the proceeds from the retirement is allocated between the liability to be settled and the equity portion for the conversion feature. the method used in allocating the conversion consideration paid or the retirement price um, to the separate components of liability and equity is consistent with that used in the original allocation to the separate components of the proceeds received by the entity when the convertible instrument was issued. So same lang doon sa issuance, yung bifurcation. Once the allocation of the consideration is made, any resulting gain or loss is treated in accordance with accounting principles applicable to the related component as follows. So, the amount of gain or loss relating to the liability component is recognized in profit or loss, whereas the amount of consideration relating to the equity component is recognized in equity. So, consistent tayo. There is no profit or loss amount in relation to transactions with the equity component. Okay? Okay, so for accounting for convertible bonds, let us have this illustration. So on July 1, 2020, the company issued 10% 10,000 bonds at face value. The holder of each bond is entitled to convert the bond into 80, 100 par ordinary shares of HP Inc. at any time up to bond maturity. So notice that the compound financial instruments were issued at face value. So does it mean that the bonds were issued at no discount or premium? The answer is no, because even if the bonds were issued at face value, remember that the bonds have conversion feature. Therefore, the issue price, which is the face value of the bonds, is to be allocated between the liability component and the equity component. The issue price, which is the face value, is not just for the bonds, but for the bonds plus equity component. So, different story yon if the issue price, which is the face value, is for bonds alone. If that is the case, we can conclude that the bonds were issued at no discount or premium. But in this example, the issue price, which is the face value, is for the compound financial instrument. For allocation pa siya between the bonds and the equity. Therefore, our safe conclusion here is the bonds were issued at a discount. Okay? When the bonds were issued, the prevailing market rate for similar bonds without the conversion option is 12%, and the bonds pay interest annually at June 30 and mature on June 30, 2025. So 5 years. So again, the fair value of the bonds without the conversion feature is not given. So we will use the present value of the bonds. On June 30, after receiving the annual interest, holders of 120 bonds exercised their conversion privilege. The remaining bonds were retired on maturity date. So in one problem, we have the conversion and we have the retirement. Prepare the entries to record the issuance until maturity. Okay, so similar with accounting for bonds with share warrants, since the market value of the bonds without the convertible feature or the conversion feature is not readily given, we compute the present value of the principal and the interest. So again, we will use the present value factor for 12% at how many years? It's from 2020 to 2025, 5 years. 1, 2, 3, 4, 5. Okay, so first, the present value of the principal, that's 2 million times the factor of 12% in 5 years, 0.5674. And the present value of interest, which is at 10%, so 10% times 2 million times present value factor of 12% ordinary annuity 5 years. It's 3.6048. So the present value of the bonds payable or the present value of the bonds without the conversion feature is 1,855,760. Next, we determine the value assigned to the conversion feature. So that amount of 1,855,760 is deducted from our issue price. Our issue price is how much? is at face value. So issue price is 2 million at 100. Why 100? Kasi face value at 100%. So 2 million less the present value of our bonds without the conversion feature, which is 1,855,760. Therefore, the value assigned to the conversion feature is 144,240. Okay, so since we already determined the um, needed amounts for our entry, we can now have this entry for the issuance of our convertible bonds. So debit cash for 2 million, that is our issue price. Another debit for the discount. Why we have a discount? So after we prepare our entries for the issuance of the convertible bonds, let us now have our amortization table. So we will amortize the issue price of the bonds, which is 1,855,760. So here is our amortization table. So as you can notice, on June 30, 2022, so 120 out of 200 bonds were converted. So we deduct the carrying value of the 120 bonds from the carrying value of the 200 bonds. Therefore, after June 30, 2022, so by July 1, 2020, the opening balance or the beginning amortized cost of our bonds is 761,546. And therefore, since the face value of the bonds decreased, our nominal interest also decreased, and then our effective interest decreased as well because the carrying value or the amortized cost decreased, and then the amortization is also affected, and so on. So by the time that the bonds mature on June 30, 2025, we only have 800,000 face value bonds because the 1,200,000 face value bonds were converted on June 30, 2022. Okay, so we will use that amortization table in our future entries. So on December 31, 2020, our first year, first 6 months, our entry will be debit to interest expense for 111,346. Yung 222,691 on June 30, 2021, half lang yan kasi 6 months. Interest payable is 1/2 of 200,000, and then discount on bonds payable, the difference. And then on June 30, 2021, our first interest payment date, we will debit the remaining 6 months, 111,345, and then the interest payable of 100,000, credit to cash of 200,000, and another discount on bonds payable of 11,345. Next, now for the second year, so our entry on December 31, 2022 is debit to interest expense 112,707, credit to interest payable of 100,000, and discount on bonds payable of 12,707. And on June 30, 2022, prior to the conversion, our entry is debit to interest expense 112,707, interest payable of 100,000, credit to cash of 200,000, and discount on bonds payable of 12,707. And after the payment of interest on June 30, 2022, we can now have our entry for the conversion. Now, our entry for the conversion of the bonds payable on June 30, 2022 is number 1, debit to bonds payable account for 1,200,000 and credit to the discount on bonds payable account for 57,681. Okay, so yan muna. So first, we debit the bonds payable account at face value, which is 1,200,000. That's the face value of the bonds converted on June 30. And we credit the discount on bonds payable, which is 57,681. How did we arrive at that amount? The face value of 1,200,000 is compared with the carrying value of the converted bonds payable, which is only 1,142,319. So 1,200,000 minus 1,142,319 is 57,681. So by that entry, debit to bonds payable and credit discount on bonds payable, the carrying value of 1,142,319 was cancelled. Okay? Next, debit to the share premium conversion feature account for 86,544. That is 120 over 200, 60%. 60% of our initial amount, which is 144,240. And then credit to the ordinary share capital account because we will issue shares in exchange of the bonds cancelled. So what's the ratio? So each bond is entitled to 80 shares at what is the par value? 100,000. So 120 bonds times 80 shares times 100 par value. So our ordinary share capital is credited for 960,000. And then the balance is credited to share premium issuance. So our total debit is 1,200,000 plus 86,544 minus the discount of 57,681 and ordinary shares of 960,000. Therefore, our share premium issuance is 268,863. Or we also have a shortcut for that. First is you determine the carrying value of the bonds converted, which is 1,142,319 plus the share premium converted, or the share premium conversion feature, which is 86,544. So that is our total consideration less the par value of the shares issued, which is 960,000. Therefore, our share premium is 268,863. Okay, so the year after the conversion on December 31, 2023, so our entry will be interest expense 45,693, that is 91,386 divided by 2. So only for the first 6 months. Credit interest payable of 40,000 and credit discount on bonds payable of 5,793. And then on June 30, 2023, debit interest expense 45,693. Similar for the interest expense on December 31, 2023. And then debit interest payable of 40,000, credit cash of 80,000. So for the whole year, we paid the interest for the whole year of 80,000 and discount on bonds payable for 5,793. Next, in 2024, so our entry on December 31, 2024 is debit interest expense 46,286. So 6 months, interest payable 40,000 and discount on bonds payable 6,286. And then on June 30, 2024, entry is debit to interest expense 46,286. Interest payable of 40,000, credit to cash of 80,000, and discount on bonds payable for 6,286. And then for the last year, just prior to the retirement, so prior maturity. So debit interest expense 47,160 on December 31, 2025, interest payable of 40,000 and discount on bonds payable of 7,160. And on June 30 for the payment of interest, debit interest expense of 47,160, interest payable of 40,000, credit to cash for the whole year 80,000 and discount on bonds payable 7,160. And finally, to record the retirement of the bonds payable on maturity date, meaning the bonds were not converted but paid on maturity date. So binayaran na natin ang ating mga bondholders on maturity date. So our entry will be debit to bonds payable account for 800,000. That's the face value of the bonds on maturity. And then debit tayo ng share premium conversion feature. Why do we need to debit this account? Because this account will be transferred, um, although within equity, to another account, because this is no longer a privilege. This is no longer a conversion privilege. So this is transferred to another equity account, which is share premium unexercised conversion feature. That's the credit account. And other than that account, we also have to credit the cash of 800,000 for the payment or the retirement of the bonds payable. So again, debit to bonds payable of 800,000, debit the share premium conversion feature for 57,696. That's the balance of our conversion feature, 40%. Credit to cash for the retirement or the payment of the bonds, and credit to share premium unexercised conversion feature. So that is actually an option for the entity to transfer within equity the balance of the equity component. And now for our last illustration. So on January 1, 2020, the company issued 5 million convertible bonds bearing an annual interest rate of 8%. Interest is payable annually every December 31, and the bonds mature on December 31, 2024. The bonds were sold at 104 and are convertible into 40,000 ordinary shares of 100 par. Without the conversion privilege, the bonds would have been sold to yield 10%. So again, the fair value or the market value of the bonds without the conversion feature is not given. So we will use the present value. On December 31, 2022, so that is after 3 years, after paying the periodic interest, 1 million bonds were converted. So conversion before maturity. On December 31, 2023, after paying the periodic interest but before maturity, 2 million bonds were retired at 101. So the second transaction is retirement of the bonds but before maturity. On that date, the market rate of similar bonds without the conversion privilege is 11%. As you can remember in our discussion in the previous slides, if the bonds are retired before maturity, or if the bonds are retired, okay, the retirement price will be allocated between the liability component and the equity component. So magba-bifurcation ulit tayo by December 31, 2023 to allocate the 101 retirement price between the liability component and the equity component. So prepare the entries to record the issuance, the conversion, and the retirements of the bonds. So we will no longer prepare the entries relating to the amortization of the bonds. So we'll focus on the issuance, the conversion, and the retirement. Okay, so first we determine the present value of the bonds without the conversion feature. So the present value of the principal is 5 million times the present value factor for 10%, 5 years, which is 0.6209. So our present value of principal is 3,104,500. Add the present value of interest, which is 5 million times the nominal rate of 8% times the ordinary annuity factor for 10%, 5 years, 3.7908. So our present value for the periodic interest is 1,516,320. So the present value of the bonds payable without the conversion feature is 4,620,820. And that amount will be deducted from our issue price, which is at 104. So issue price is 5 million times 104% or 5,200,000. Deduct the present value of the bonds without the conversion feature, which is 4,620,820, and therefore the value assigned to the conversion feature is 579,180. So our entry for the issuance of the convertible bonds is debit to cash 5,200,000. That's our issue price. Another debit to discount on bonds payable because the bonds were issued below the present value of the bonds without the conversion feature is less than 5 million, only 4,620,820. So we will have a discount on bonds payable for 379,180. Credit to bonds payable for 5 million and credit to share premium conversion feature of 579,180. So that's the value assigned to the conversion privilege. Okay, again, so we will prepare our amortization table. So on December 31, 2022, 1 million out of 5 million bonds were converted. So the carrying value of the converted bonds is 965,262. And then on December 31, 2023, 2 million out of the remaining 4 million were retired. So the carrying value of the 2 million bonds is 1,963,577. So our entry on December 31, 2022 in the 1 million face value bonds with carrying value of 965,262 were converted is debit to bonds payable for the face value of 1 million and credit to discount of 34,748, that is 1 million less 965,262. Then debit to share premium conversion feature, which is 115,836, that is 20% of the beginning balance. Why 20%? Because 1 million out of the total 5 million is 20%. And then credit to ordinary share capital for 800,000. What's our ratio? So the bonds were sold at one offer and convertible into 40,000 ordinary shares. So 40,000 ordinary shares times 20%, that is 8,000 shares times par value of 100. So our credit to ordinary share capital is 800,000. And the balance is credited to share premium issuance. That's 281,098. So again, what's our shortcut for that? So the carrying value of the bonds is 965,262 plus the share premium conversion feature, which is 115,836, less the credit to ordinary share capital at par of 100,000, which is 800,000. So our share premium is 281,098. Okay, so next is our entry on December 31, 2023 for the retirement of the 2 million face value bonds out of the remaining 4 million. But before we prepare the entry, let us first determine the present value of the remaining 2 million bonds as of December 31, 2023. Okay, so on December 31, 2023, after paying the periodic interest, 2 million bonds were retired at 101. On that date, the market rate of similar bonds without the conversion privilege is 11%. So we will compute the present value of the bonds for 1 year at 11%. So present value principal, that's 2 million times 0.9009. That is our present value for 11% 1 year. So 1,801,800 plus the present value of interest. Actually, the present value factor for ordinary annuity of 1 or present value factor for 1 is the same if the remaining period is only 1 year. So 2 million times 8% times 0.9009, it's 144,144. So the present value of the bonds is 1,945,944. So that's the market value or the present value of the bonds without the conversion feature. Next is we allocate the retirement price. So the retirement price, which is 101, it's mentioned in the problem. So that's 2 million times 101 is 2,020,000 is allocated between the bonds and the equity component. So for the bonds, we have 1,945,944. So out of the 2,020,000 retirement price, 1,945,944 is allocated to the liability component. Therefore, the retirement price on account of equity or the retirement price assigned to the equity component is 74,056. And with that figures, we can have this schedule. So for the liability component, the retirement price is 1,945,944. The carrying value of the bonds is 1,963,577. So meaning the liability that should be paid is 1,963, but the amount that we actually paid is 1,945. Therefore, kumita tayo or lugi tayo. Again, ang utang natin is 1,963,577 but we will only pay 1,945,944. So mas maliit ang bayad kesa sa dapat bayaran. Kita yan. So 17,633 is a gain on our retirement of the bonds payable. Next, the retirement price on account of equity is 74,056 but the balance of the equity is 231,672. Saan galing yan? That is the 40%, 2 over 5, 40% of the beginning balance of equity. So 231,672 ang carrying value but the retirement price on account of equity is only 74,056. Therefore, we have a gain on account of the retirement of equity which is taken to equity also of 157,616. And with that, our entry for the retirement of the 2 million bonds payable is debit to bonds payable 2 million face value and credit to discount on bonds payable of 36,423. So pag ninet mo yan, 2 million minus 36,423, 196,357. That is the carrying value of the bonds retired. So kinancel na natin ang 2 million bonds. Next, debit to share premium conversion feature which is 231,672. Again, that is 40% of our share premium conversion feature. Next, credit tayo ng cash for 2,020,000, our retirement price. And then, credit tayo ng gain on retirement. This is taken to profit or loss, 17,633. And then, the gain on account of equity, which is 157,616, is taken to another equity account. So, transfer within equity, 157,616. Okay? So, that is accounting for convertible bonds, and of course accounting for bonds with share warrants. Thank you.